got the manipulation of all the paper, but it's on top of the fact that silver is largely a byproduct of mining copper, tin, lead, zinc, and gold. And but if there's an economic crisis, then and the economy slows down, there's less use for copper, tin, lead, zinc, and gold. They're not building as many homes. They don't need as much wire or copper pipe and so on. And so there's less silver coming to market just when everybody is rushing toward it as a safe haven. The supply falls as demand increases. So the manipulation will come to an end, and a lot of people that are on the short side are going to end up going up in flames.
The silver market is currently noisy. Price action is volatile, and traders are trying to figure out whether support will hold. But step back, and the broader structure still leans bullish. MikeMaloney, a veteran in the precious metals space, points to something more profound than short-term speculation. Silver, he argues, is reacting to real-world inflation, the kind that CPI numbers tend to gloss over. He draws a straight line to the 1970s and early 80s, when inflation and currency debasement led to massive moves in both gold and silver. But this time, the setup might be even more compressed. According to Maloney, the vast majority of people still don't hold any physical gold or silver. That leaves the market dangerously underowned. If demand spikes suddenly, driven by panic or distrust in fiat, supply simply won't meet it. Inventories are already thin, and long-term holders aren't selling. That's how parabolic moves start. Ray Dalio is on a similar page. With U.S. government debt spiraling, he's urging investors to shift 15% of their portfolios into gold and Bitcoin, not for profit, but for protection. The message is clear: don't assume the current system is permanent. Meanwhile, central banks, especially across Asia, aren't waiting around. They're quietly pulling gold and silver from Western vaults. This isn't speculation, it's preparation. Jan Nieuwenhuis has tracked the shift. Non-Western countries now hold over 18,600 tons of gold, quickly closing in on the West's 21,470 tons. That's nearly half of the world's official reserves, and the gap is shrinking. This wave of accumulation isn't coming from retail traders. It's coming from institutions, sovereign wealth funds, and central banks that are preparing for a post-dollar future. Yes, silver's short-term moves are messy, but that's not the story. The deeper trend, stealth accumulation, supply tightness, monetary uncertainty, points to something much bigger. When the public finally catches on, it won't be a gradual climb, it'll be a sprint. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, it should be up in triple digits, and it will be.
You think so? Triple digits?
One thing it requires, we were talking about gold counteracting inflation, that it was completely offsetting it, and that what you're seeing is the true rate of inflation revealed, and that's what John Williams believes too. But the public has not come rushing in yet to protect their purchasing power. There will come a day where gold and silver do go into bubbles, and what happened in late '79, silver had lagged gold for the entire, it was from August 15th, 1971. Gold took off. Silver lagged. It did go up, but then November, December, and the first 20 days of January, silver just blew the doors off of gold. And I believe that same thing will happen. And it was once gold passed the $400 per ounce level in '79 that the character of how these things were traded changed. And when people were looking at it and going, oh, it was $35 an ounce just, back in 1971. Yep. Here it's 8 years later, and it's up at $400 an ounce. It's getting a little expensive. How much is the silver? Oh, yeah. Well, you can get 50 of those for one of these. Oh, well, give me the silver. It's when they change their preference that then silver goes into a super bubble. And I think the same thing is going to happen this time around. So it'll blow way past in my opinion, from studying the last great bull market in the metals, when the public gets really worried and they're seeking that safe haven. And right now, it's a very small percentage of the public that own gold. Most of the public has absolutely no exposure. Well, and when they try to come rushing in, the only thing that can make up the difference, that's a lot of demand and very little supply. And as the price goes up, the people that own it want to hang on to it more. It's a Giffen good.
Yeah.
And so as they hang on to it and they don't fill that demand, the price has to go even higher. It's going from the west to the east, which saddens me because it really does look like we are headed toward some sort of monetary system that has a link to gold. And the more that heads from west to east will determine how wealthy we are as a nation in the end. And so they're going to end up a little bit wealthier. Yep. We're going to end up a little bit poorer. But what I see too in current demand, I'm a precious metals dealer and I talk with other precious metals dealer, and it's not the West. We're seeing these price rises, and for some reason it is not the Western public that is doing the buying, but the price is going up. It's central banks setting a floor under it with their purchases, and then all of the Chinese demand that you just spoke of. That is what's driving the price. I just spoke here at Limitless. I spoke to the smallest audience that I have had in at least 19 years. There were 44 people in the audience. Yeah. And here, Dana Samuelson, another gold dealer, and I are on this panel. So it's the only gold panel at this conference, and there were 44 people in it. It just wasn't something that the public is interested in yet. But boy, they will be when it's at 5. It's like, I used to say, when somebody would say, well, gold was $250, or not 250 when it bottomed, but 300, 400 when I first started promoting it. And people would say, yeah, but I want to stay in the stock market right now for this. Gold's been going down for 20 years. And I'd think in my head, you look like a $5,000 guy. You're going to wait. It's $300 an ounce now. You're going to wait until it's 5,000, and then you're going to buy. You've got the manipulation of all the paper, but it's on top of the fact that silver is largely a byproduct of mining copper, tin, lead, zinc, and gold. But if there's an economic crisis, and the economy slows down, there's less use for copper, tin, lead, zinc, and gold. They're not building as many homes. They don't need as much wire or copper pipe and so on. And so there's less silver coming to market just when everybody is rushing toward it as a safe haven. The supply falls as demand increases. So the manipulation will come to an end, and a lot of people that are on the short side are going to end up going up in flames. I'm trying to take emotion out of it and let math do that for me. So I've got 23 indicators that we're in the process of back testing, and I'm trying to use indicators plus confirming indicators. For instance, the Dow Gold ratio has been an indicator that people have been using for a long time. And we know that if you look at the last bull market, the Dow Gold ratio went to 1. There was a day where gold hit an intraday high of 873 and the Dow was at 873 points at the same time. Yep. So 1 ounce of gold was worth the same amount of the points on the Dow. They were equal. You take the Dow Gold ratio, and at the same time, that is when the gold-silver ratio did a spike it came from 50 down to 14. So it peaked on the same day. So it's basically a confirming indicator for the Dow Gold. And I've got a whole bunch of them that we're back testing like that. And then we're trying to figure out the weightings. But what I plan on doing is selling a certain percentage, say 20% of my holdings at certain ratios. And then if it doubles again, I've got 80% left that doubled, and I sell 20% of that, and 20% and 20%, and hopefully I can get around that peak. Anybody that says that they can nail the peak is lying, and if they do, it was a complete accident. It was luck.
U.S. stocks have ripped higher since April. The S&P 500 is up 29%. The Nasdaq, nearly 40%. At first glance, it appears to be a full-blown recovery, but that's surface level. Underneath, the cracks are showing. MikeMaloney points to the Buffett indicator, market cap divided by GDP, which now sits at 208%. In plain terms, the stock market is worth more than twice the entire U.S. economy. That's not growth, that's distortion. And the rally itself is fragile. It's being carried almost entirely by a handful of mega-cap tech names. Strip those out, and the rest of the market looks flat at best. That kind of concentration doesn't end well. When sentiment flips, it flips fast, and money doesn't just leave equities. It sprints toward tangible assets, such as gold. We're already seeing early signs. The S&P has dipped below its 20-day moving average. Utilities, one of the most defensive sectors, just hit a 52-week high. That's not bullish exuberance, it's risk-off behavior. Meanwhile, the economic backdrop is getting shakier. Consumer data is soft. Tariff threats are back, and the Fed is paralyzed, neither easing nor tightening. Some analysts now expect the S&P 500 to fall as low as 6,100 if seasonality and macroeconomic pressures align. Let's get back to the interview.
I don't think it takes hyperinflation, though, to make gold go vertical. It just takes a big rush toward it. And because there are so few people that own gold right now. And if you look at the average, Rick Rule, I can't remember the numbers, that 8% of the population used to own a reasonable amount of gold, and now it's below 2. And so what does it take to get back to that 8 as far as demand? And I think that the crisis that is coming, like you just said, we've never been this far out of balance before. So to reestablish an equilibrium in the economy, what does that require as far as a correction? One of the things that I sort of proved in my book is that we are living in I think it's chapter 5. Everything is in a bubble. We are in the bubble century, and every time the bubble tries to go back into equilibrium with the rest of the economy, the Fed rushes in to save us, and they pump everything back into a bubble. And you were talking about the number of hours worked to buy a share of the S&P, or one of the things that my researchers found was this real obscure data by a couple of economists in Europe, where they took 17 advanced economies, and they took this back to the early 1700s. It was the Buffett indicator for the world, going back into the 1700s. And it goes along at averaging about 30%, the markets being the value of about 30% of the economy. And then just suddenly it just goes haywire. And what is it at right now? The Buffett indicator for the U.S. is at 200 and something?
208 last I saw.
208. Why is the stock market, and mostly just these 7 stocks that you were talking about, worth more than double what the size of the U.S. economy is in a year? This is nuts. It is absolutely insane. We are living in very historic times right now. And, the on-again, off-again tariffs are constantly changing. It has...
Yeah. Let's talk about that.
I know that I have had to put off purchases for my farm because some of the purchases come from Poland. These mobile chicken coops that we're trying to buy.
I can't wait to hear about that. I want to hear more about that, but keep going with tariffs.
Yeah. And, they're supposed to go from 1.4% to 30% on August 1st, but now there's this deal that supposedly is struck, but I don't think anything's signed yet with the EU, so 15%, but that raises my costs by 15% if that goes through, but we don't know if that's going to change tomorrow or not. So business has to just stop and get put on pause until businesses can't operate in an uncertain environment. They have to have something where they can predict what's going to happen tomorrow, next month, next year. And so I see that this perturbation that we're doing to the economy right now should show up in some sort of crisis, something that should happen 6 months, 9 months, a year later. I don't know when, but it has to flow into the economy. What's your thoughts on that? This big bad boondoggle is what I call it. The one big bad boondoggle bill act. How can you...
Which saves nothing, backloads it, so let future people wrestle with that.
Deficit spending, more debt, a bigger national debt, sticking future generations with a bigger bill, and that this ultimately can't work out. It's just more borrowed time kicking the can down the road.
Yeah.
And so it's what every other politician has done.
Yeah.
Run on one platform and then completely ignore the promises that you made. I am disappointed. I hate to take I like teaching economics. and letting people make up their own minds. So I typically try and stay away from politics and taking any particular stance. But yes, I'm confused by the actions, especially when it comes to tariffs. My question is, where is Congress in all of this? A president isn't supposed to be able to, the Constitution lays out how the government is going to work. When you read the Constitution, a whole lot of it is really boring stuff about how the government is going to work.
Yeah.
And right now, the president is acting very much like a king or a dictator. And waking up in the morning and changing the way the global economy is going to work, according to some idea he had when he was waking up that morning, it's upsetting the apple cart, to say the least.
Gold pushed higher on Wednesday. The latest ISM Services PMI came in at just 50.1 for July, missing expectations and barely avoiding contraction territory. At the same time, geopolitical tension added fuel to the move. After targeting India with tariff threats earlier in the week, President Trump shifted focus to Europe, warning of 35% tariffs on Eurozone goods if trade commitments aren't met. Markets took the threat seriously. Rising friction on multiple fronts, economic and geopolitical, has created a landscape where defensive assets are back in demand, and gold, once again, is leading the charge. Silver's volatility might be grabbing attention, but the fundamental shift is happening quietly behind the curtain. Institutional buying, sovereign stockpiling, and thinning inventories are setting the stage for a market that won't wait for retail sentiment to catch up. Gold is already moving. Silver's lag isn't a weakness, it's compression. When scarcity meets sudden demand, markets don't move in straight lines, they lurch. At what point does cautious positioning turn into a missed opportunity in a system where trust is eroding and time favors those already in the trade? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.